Scorpio Trading. This is our first video, which is also part of series. And in this video, we are going to talk about something that is very seldom discussed, and that is complex trading systems. So when we talk about a complex trading system, what we are basically talking about here is one that uses a larger number of variables and concepts to filter out bad setups. And this topic is almost taboo in the retail space because of the notion of KISS. So keep it simple, stupid, or keep it stupid, simple. But if that was actually the case, why do large hedge funds and institutions spend so much on analysts, engineers, software, etc.? But they don't, right? But they do. So when you ask yourself that question, you should question yourself of the notion of KISS. And with that being said, there are no absolutes in trading, which means simple systems can work for some people in some instances. So as a whole, we are talking about what is optimal for most people. And trading is a hard endeavor in itself, and we need the most edge we can find, which means a relatively complex trading system might be a better option for most people or simpler. So we'll get into detail about this. So we'll go over what we are going to discuss in this video and what to expect further into the series. First of all, we have to understand why simple trading systems may not work as well as one might think. And then we have to understand what a complex trading system is. And once we do that, we have to understand the three pillars of expectancy, because that is very important when it comes to building your own system to match your own personality. And that's also important when it comes to the fourth point, where we talk about the spectrum, which is the combination of the three pillars, which is most suited to you and compatible with you. And then we'll go over some common concepts which are used in the smart money area and go into different perspectives. This is basically an introduction there, and then we'll go further about these concepts further into the series. So first of all, we'll talk about the bane of simple trading systems. So why are these popular? They are easy to learn and reach because they have less variables, less concepts. So they are much easier to learn and teach. And because of this, these are really common. And because these are really common, they also have this notion that you can earn money fast. Why is that? Because if you take less time to learn it and you have to expend a lesser effort to learn it, then there's this illusion that you can start the process of earning money fast, though it almost always doesn't happen that way. But what it does do is that it attracts a lot of traders. And when that happens, it also reinforces this existing idea that a simpler system is something that you can use to earn money quickly. And that is probably the origination of KISS. So keep it simple, stupid. Why? Because it's easy. So that becomes popular. So the cycle repeats itself. So when we talk about simple trading systems, this is basically a system where you use less variables or concepts. And once you do that, it lowers the ability of that system to filter out low probability trades. So now you have less filters, which means a lesser ability to filter out good setups from the bad setups. And what this results in is that your system becomes highly dependent on certain market conditions. So because the market is unpredictable in itself, your performance of the system also becomes relatively unpredictable. And this results in larger, longer periods of drawdown and an unpredictable equity curve. And what that does then is it results in multiple psychological issues, such as hesitation, for example, because if you're in a larger period of drawdown, or if your drawdown percentage is really high, then you're going to hesitate. You're going to second guess your system. And so you might miss your trades, you might overtrade to catch up for previous losses. And what all of this results is in an accumulation of stress, which is related to the system, and that can lead to other problems as well. But mainly what then happens is that it contributes to strategy hopping, because now you think that your system doesn't work. And if it doesn't work, what most people do is try to find something that works. and you go through this vicious cycle and end up not being consistent profitable. And a logical solution for this is to design a system which has the potential of lesser and shorter drawdowns and a more predictable equity curve. And so to do this, you have to go against the grain, because this requires a complete overhaul of conventional thinking, because you can't use the notion of KISS here. And don't get me wrong, like you can keep things simple when it comes to processes and such, but when you're talking about the system itself that you use to trade, then KISS is probably not the way to go. And all of this said, what that eventually leads to is to a relatively complex trading system. And so when we talk about complex trading systems, here we use multiple compatible concepts together, and sometimes there are sub-variables to filter out low probability trades to a much larger extent when we compare it to a simpler system. And when you do this, you become less dependent on market conditions, as in your system performance is less volatile. But the issue with this is that they are harder to learn and teach, and it requires a longer duration and much more effort from the perspective of the student. And this means this is very rare that you find someone who trades a relatively complex system. And the increase in length and effort that is required to kind of get an idea of what a complex trading system is and be good at trading it, it means now you are going to take more time to earn. And this kind of dissuades people from actually trading in this manner. So it's lesser attractive to most traders and less popular because it also goes against the grain. But what this allows for is better consistency and continuity. And especially if you use this alongside rolling reviews to adapt to changing market conditions. And we'll talk about rolling reviews later into the series, but it's basically you are weighing recent performance a little bit higher than past performance. So you get an idea of what is changing and adapt accordingly. And when you use a complex trading system, you have lesser volatile equity curves and shorter and smaller drawdowns potential. And all of this means your psychology is in a much better place, and you'll be able to better trade your system the way it is intended to be. So the goal of the series is to introduce different perspectives through which one can either improve their current systems or develop entirely new and robust trading systems. And when we talk about this, or when we talk about designing your own systems or improving current systems, first we have to understand about the three pillars of expectancy. And these three are win rate, risk reward ratio, and frequency. And when we talk about these three, there's a very common myth that should be demystified. And that is the inverse relationship between win rate and risk reward ratio. The myth is that win rate and risk reward ratio is mutually exclusive. So you can't have a high win rate with a high RR, and that is the notion. But it's very contextual and almost always misinterpreted. And what this results in is traders settling for far less than what they're capable of. But we can demystify this when we actually look at the real relationship in between the three variables. So let's assume you need a high win rate. So if you need a high win rate, what you're trying to do is increase your variables, because that is how you filter bad setups out. And when you increase your variables, then your frequency is naturally going to lower. So the relationship is win rate is going to be inversely proportional to frequency. And the same goes with risk reward ratio, because if you're going to increase your risk reward, then what that means is either you're going to have to minimize your entry, which means your stop loss, or maximize your gain. In each case, what you're going to do is you're going to, if you are going to minimize your stop loss, that means the potential of your entry being tapped is reduced. And if you're going to increase your profit target, then the potential of price hitting your TP is going to be minimized. So in both cases, your frequency is going to be decreased. So only when the thesis is controlled, so say you have the same trade idea, then yes, then at that point, win rate can be inversely proportional to risk reward. But that is only because of frequency. Because when risk to reward ratio is increased, then your frequency is going to be decreased. And because your frequency is decreased, the weight that one particular trade carries is higher. So that is why, as a percentage, your win rate is going to be reduced. But the actual relationship goes through frequency, and it's not a direct relationship. And what all of this means is that there is no inherent inability to have both high win rate and high risk reward, which means that you can have both higher win rates and higher risk reward ratios. And this relationship between these three parameters is extremely important because this allows you to manipulate these metrics within your system or portfolio to be compatible with the trader. So what we are going to try and do here is to make sure that the trader himself and the system are compatible. So this is where we have to talk about the spectrum. So a good trading system comprises of two things. So you need to have a relatively consistent expectancy per period. And here the period depends on the frequency of your system per se. So say it's a intraday system, it's probably a year. But if it's a swing system, maybe 2-3 years. So it's a large duration of time, because we all know that in shorter durations of time, any system can have relatively volatile outcomes. And the second factor is that whatever trading system you use should be compatible with the trader. Individuals have different attributes. So you're going to have different attributes, as in your patience. It can differ among individuals. Your tolerance for risk can be different among individuals. So as such, we should minimize clashing against these attributes, and we should manipulate the variables so that the person and the system is compatible. So to do that, the best thing is, first, one should understand where he or she falls within the spectrum. So say you have win rate, risk reward, and frequency. So are you going to prioritize win rate, or are you going to prioritize risk reward ratio, or are you going to prioritize frequency? And once you decide on that, you have to not have unrealistic expectations based on their interrelation. For example, you can't have a very high win rate and a very high frequency together, because those two are not mutually inclusive. Because if you're going to increase your win rate, you're going to increase the number of variables, which means your frequency is going to decrease. So you can't have that, right? So you have to understand where in the spectrum you are and design a system that is compatible with that. And what all of this does is that you can have a better consistency and a sustainable adherence to the system. So once you have both of that, that means the probability of you hopping strategies from one to another is going to be very less, because you're more comfortable executing the system because it feels more natural to you. And now we come to the meat and potatoes of this series, which is where we are going to discuss about different concepts and sub-variables within that concepts, which you can use to filter out bad trades. And in this video, we are only going to have more of an introductory role regarding these concepts and sub-concepts, and each of these will be taken in itself and discussed further into the series. So first of all, we look at ranges, which is probably the most foundational of all concepts, because assuming you trade smart money, this is basically the first step that you're going to consider. Even if you're using fair value gaps, then that is going to be within a range. If you use the range itself, it's still a range. So such. And when we talk about ranges, we have to first talk about types. So types can be different, right? It can be based on direction, which means a continuation or reversal. So you have, and then within those directional ranges, you can have ranges that have support and that doesn't have support. And then you have to talk about context, which can be basically a pro-trend, counter-trend, and oppositions. And current ranges, which is something, again, not many people talk about, which is what range is valid at a particular point of time. And then you have to talk about exhaustions, because we have seen that not all ranges give you a reaction that goes and results in a break of structure, right? Because some of them move halfway and then come back down. So you have to understand when that happens, how that happens, and how you can use that to your advantage. And then premium and discount, which is self-explanatory, but again, people use the 50%, but that's not exactly probably the best way to use it. And then confirmations. And then liquidity, probably the most important one. And here again, you can talk about types, which is basically about formation and purpose. And then if a breach in liquidity is actually liquidation or a breakout, how you are going to identify that? And then relevant liquidity, because not all liquidity is created the same, and some may be more relevant to a particular range than another. And then about where it is located and the size of that liquidity. And then we have to talk about order flow. And here we'll talk about efficiency and relevant ranges. And especially when we are talking about inefficiencies, are you going to use fair value gaps, or is there a better alternative? And then we had to talk about liquidity within the order flow. What is relevant, what is not? And then order flow and control, which is something barely talked about. And then at the end of the day, we have to talk about merging ranges, liquidity, and order flow together, so you can have the best idea of what price is going to do. And now, with all this is basically an introduction, so you're not going to get much here, but when we go deeper into these in the following videos, it's going to be much better. And then you have time, where we'll be talking about time-bound liquidation. And this is not like most people do. So you assign a time for a particular liquidity on when it was created. So previous daily high or previous daily low, New York session high, etc., etc. I'm not talking about that. I think there's a better way on which we can use time. And this is basically not when it was created, but rather the time it took for something to be created. And there's a distinction in that. And I think that is a much better way to use liquidity. And then time cycles, which is something most people use and use it pretty well as well, such as daily cycles, monthly cycles, weekly cycles, etc. And then ADR. And here I know some people use it for different purposes, but I think this is something that can bind your systems together. So you can use this as a mechanical filter, as in percentages. You can use a specific percentage of ADR for a specific purpose. And then one shot, one kill setups. And finally, we'll talk about some other, these aren't concepts per se, but we'll talk about entries, trade management, and utilization of the FIB. And FIB not as in a golden ratio or anything, but rather more alongside ADRs to use as percentages. And then about portfolio management. And now here, all of this is just the introduction. And the goal of this video is just to give you an idea of what you can look at. And when we go deeper into this, you'll have a much better understanding of what to expect. And see you on the next one.